Welcome to the Campground Catalyst Podcast, the show dedicated to fueling success in outdoor hospitality. Whether you're an outdoor adventurer, a campground owner, or looking to build your legacy in outdoor hospitality, you're right where you need to be. We're here to guide you through the fascinating world of campground management, unique real estate strategies, and the gratifying opportunities created by outdoor hospitality. Our mission is to inspire and equip you with the knowledge and insights you need to build a successful business and create a legacy worth leaving. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted outdoor hospitality experts. Subscribe now, join our active online community, and let's ignite our passions and potential together. Welcome back to the Campground Catalyst Podcast. I'm Adam, here with Justin, Robert, and Don. How you guys doing today?
Doing well.
All right, awesome. We're back in with another campfire cash flow segment of the show. And today we're going to be talking about how you put together the financing to buy a campground. This is something that is not as straightforward and clear-cut as you might think. Justin, how was that process for us when we bought our first campground?
Painful. It's probably gotten a lot better since. Certainly for us because we have multiple campgrounds, but the first one, it just, is a new space. You have to find a lender that is willing to do a campground, which is half the battle because we call it an alternative asset class. And so, how many phone calls do you think we made to get to where
I don't know how many phone calls, but I can tell you about how many lenders told us no. And it was near 50.
Yeah.
That's not an exaggeration.
Yeah. And then, and how many paperwork applications do we have to send, our financials? I mean, holy cow, it was some work.
Yeah, you stop being so concerned about who knows your social security number because you end up giving it to everybody, it seems. I don't know how many dings I had on my credit during that time. But, fortunately for us in our journey, we didn't take no for an answer a lot of times until we finally got the yes. And that was really what opened the door for us, because the challenging thing about buying a campground, like Justin mentioned, it is a different asset class, and the banks who are lending on these, they're going to want to invest in stuff that they know, which is why home loans are so easy, because everybody needs a home. They know homes. There's so many of them that are sold every day. Businesses, they know certain businesses. So they might know office space that really well because it's something that trades big in their area. But, they might have hundreds of office buildings in their service area, but only one campground. And maybe that campground never had a loan with them. So they really have no experience with it. And what the bank is concerned with at the end of the day is if you default on that loan and they get the property back, what are they going to do with it? Are they going to run it? Are they going to sell it? Are they going to be able to sell it? Are they going to know how to run it? We've come a long way since then. Don, I know you've been in touch with a lot of lenders of recent. What are you seeing as kind of the evolution, kind of knowing where we came from having, full recourse debt and a really hard time finding loans? What are you seeing in with the guys you talk to?
Yeah, well, luckily it's starting to open up to be a more accepted niche, I guess. There's a lot more lenders that are opening up to it and willing to do it. But still, majority of them are going to be recourse only debt. There are a few that I found that will do non-recourse. But yeah, the good news is, yes, that it's becoming more mainstream, so it's more acceptable to most lenders to want to do it and see it, especially if they've seen some maybe things not going so well in some of the other space like multifamily and things. So they're branching out and opening up to other opportunities. But yeah, it's still, I think overall, it still could be a challenge, especially if you don't have the experience doing it already. Most commercial lenders want you to have some experience in this space that they're lending on. If you're looking to, buy a large multifamily building that you or somebody on your team on the loan that has experience with multifamily, or in this case with campgrounds or anything else, they like to have some kind of that you know what you're doing. And if you're not, that you're going to at least hire out a third-party property manager that knows how to run it and operate it. But obviously, still going to be some requirements there to have the balance sheet or the liquidity needed to secure that loan as well. But the good thing is that, again, things are changing. It's going to get easier over time. I think the next 5 years will be a lot easier than it is even today. But that doesn't mean you have to only go that route. Obviously, it's kind of the name of this episode is the creative financing, right? So there are other options you could do besides just a standard bank loan. Probably the go-to one you should always try first is the seller financing. See if the owner is willing to themselves be the bank essentially, and may come with a less down payment, less fees. not need those other requirements that the bank is going to ask of you, then you can get in with much less out of pocket.
Yeah, absolutely. Seller financing is an interesting one. And I know we've shared this on the show before, and we're certainly discussing it on Patreon. But that said, you have to approach it in the right way. Because if you think about the experience most people have, and we've discussed this before, think about the journey of your average campground owner. Most campground owners, this is a second career. They've retired from a job, they sell their house, they move to the campground. This is really their first business they've owned. So if they have experience hearing about seller financing's got a bad rap in the home market because it's so easy to get home loans. Usually the only people asking for seller financing, especially when interest rates were sub 3% a few years ago, were people who weren't qualified to get a home loan. So typically if somebody who's getting that request is, oh gosh, this guy's got terrible credit, no assets, whatever the case is. So you might have to get them over that hump, so that's going to be the first thing. And it's all in how you market it. Remember, even if we're buying the property, we're still in sales. We still have to sell ourselves to that person. And if we're going to be requesting it, we have to explain to them the benefits of giving this loan to us and why it's going to serve them. Justin, what are some of the top things that benefit a seller in providing seller financing to a buyer?
Well, there's a few things. I mean, one of the, just from the very get-go is from the start on the due diligence process and the appraisal that we would have to go through if we were buying. So that's a little bit of a benefit for the buyer too, as well, because it's a reduced expense on that end, but it also can accelerate the closing and provide the, maybe even a higher price for the seller as well. But other than that, really just having the seller reduce their capital gains responsibility. And so it's essentially a drawn out process that will reduce your overall tax liability for the property.
Yep. Perfect. Go ahead,
so
Robert.
I'm going to go back a little bit because I'm making a bit of an assumption here because you said pulling your social security number, et cetera. And I've been to enough of the weekend real estate investor seminars or the late night ones that you watch on TV where they talk about, okay, go form your corporation and then go write the contract under your corporation's number. But it sounds like from the financing standpoint, because you're getting into this fresh, they're looking at your information and your ability to pay back the loan, not the business in and of itself. Am I correct on that, or talk me through that process?
Yeah, that's correct. So if you go form a new LLC, let's call it today, and you're going to try to buy this campground under, ABC Camping LLC, if you wanted to, you could potentially finance a loan through a company. However, that company is going to have to be vetted the same way a person would for creditworthiness. And typically, if that's a brand new entity you just formed, your chances of getting credit for it are hard. I mean, try even getting a credit card guaranteed by a company and not a person. Incredibly difficult to do if you don't have at least a few years of books and, financial performance history. So if you have a company with a track record in that space, that's going to be the other important part too. You can't say, well, hey, I've been a mechanic running my own garage for years. Now I'd like to use that to get experience for, that experience to get credit for campground. It's not relative, so if you find a bank that gives it to you, that might be one thing. But yes, typically, with most bank loans, unless, Don's spoken to a few lenders and he can share those on the Patreon page with guests who might be asking, or listeners might be asking, but typically you're going to have to guarantee that loan. The bank's going to want to know that should you default, they can come after your assets for it. So you're typically going to need to put up your balance sheet, and you're typically going to need to have a credit check done, so that yes, they're going to get the property back, but they're going to also be able to recoup any other damages, from your own assets. So that's the challenge with a recourse loan, which is very common in this space. Don mentioned, of course, there are some resources out there for non-recourse, but those are going to require some experience, some history that you've got in the space. They're not going to give it typically to a first-time campground owner. It's the catch-22 of buying a campground, is that you got to have the experience to get the loan. Well, how do you get the experience if you don't have the campground? So unless you've been managing somebody else's campground for a period of time, or like you mentioned, Don, is, getting a professional manager to come in. The banks will often accept that. If you're either going to bring a professional management group in to run it, that they can feel confident is going to run it well, or you bring in a partner on the purchase who has that experience as well too. And that's something that we have offered to other folks in the past who've come to us with a deal that they're having trouble getting finance, is that, we could certainly look at, potentially creating a partnership with them.
And with that partnership,
You talked about partnership. Where do investors fit into it then? How is the bank looking at the investment side of it, of having the outside investors? Are they individually being vetted, or do they just look at the investors as being a pot of money?
It's a good question. It depends on the amount of ownership. Every bank is going to have their own requirements. It also depends on the structure of that ownership. So if you're forming, let's say, a joint venture partnership, otherwise known as a JV, where maybe you and a friend or two friends are going in on it, and you're all equal partners in the deal, the bank's going to want to look at each one of those partners individually. Now, depending on how you structure it, we structure ours in private placement offerings. So our investors become limited partners, or LPs, and when we bring them in, and they have a limited liability. Their only liability is the money they put into the deal. They're protected from all other liability. So in that case, unless one of those investors owns over a certain threshold, the bank generally doesn't even know who they are. They'll ask us up front if anybody owns more than 10% of the company, or 20%, or whatever that threshold is for that bank. And if that's the case, if you have one giant investor in there, they may be asked to put up their financials for that bank. So
going back a bit, if you're looking to buy it just for yourself, right? You're not looking to necessarily use investors, or even if you are, it doesn't matter. But if you plan to maybe own and operate it yourself, another option with some of the banks could be like a SBA or USDA loan. They may be a bit more helpful to get you that loan easier, but just the process is a lot longer and require probably more of you. But it may be a path to take if you can't get any other option to work for you.
Yeah, the SBA and USDA certainly could be an option, and there are a number of lenders out there offering it. We found from our experience they're very difficult to make work. So it's certainly worth your time to network with a good broker, a good debt broker who has experience in this industry, to find out what option is best, and have that person exploring both, private bank loans and maybe even the government options. But I wouldn't necessarily jump in on those government options as your go-to. Obviously we mentioned seller financing. Seller financing is fantastic if you can get somebody who's able to provide it to you, and the important thing on that is the ability to do it. You're going to have an idea of how much debt they currently have in the property, if any. Your ideal situation is a seller who has no debt on the property and is going to walk away with all of their proceeds, because as Justin mentioned, you can now tell them, hey, do you really want to pay the government for all that income this year, that capital gains this year, or do you want to find a way to, limit that and spread it out over time, keeping you in lower tax brackets? I said this was a sales game before, and I've gone as far as I call this a legacy option. This is, hey, do you want to? I'd like to offer you a legacy option with this purchase here. It sounds corny, but I'll tell you this: it gets people's attention. You tell them, hey, here's the deal. We're going to give you a certain amount of cash at closing. You might own this property outright, so you're going to get $500,000 at closing. That's enough to buy a new RV, to cover your living expenses for the next couple of years, whatever you decide to do with it. And then we're going to keep sending you a check every month. You're only going to pay taxes on those checks that you get every single month, and it's going to keep you in a lower tax bracket. Here's the best part. I mentioned it's the legacy plan. Your heirs can take over this note should you pass. We're going to structure this in such a way that you die, we'll now keep making that payment to your heirs, and then when we pay the lump, they're going to collect it then, and it'll be, granted, I'm not a CPA or a tax professional. I'll give my disclaimer on this, but that's going to be an inheritance at that point. It's going to be treated a little bit differently. So there's a really big advantage to the seller finance option. Some other options that are going to come up out there, especially I've seen a lot of guys go for these when they're just trying to get a deal closed, is a bridge loan. Bridge loan can be a way to get it done. This is typically going to be a non-recourse loan. However, it's going to usually have a very short fuse and typically a high interest rate. So this might be something where if you're looking for a replacement financing option that require you to have some experience, or there's some kind of a hurdle to getting it done, it can be a risk, but it can also be an option to get the deal closed. Anything else we missed, guys?
No, you'd have to think through that beforehand, because you wouldn't want to be owning a campground with Tony Soprano, because that wouldn't be the best. So there's definitely creative financing that's out there. You talked about sales as well. I'm sure that part of that with the seller financing is talking about first position, second position, as to where that particular agreement falls into place, especially if you have a bank. Am I correct in that situation as well?
That's correct. You have to consider that in the event of a default, in the event that you're going to need to be foreclosed upon because you're not holding up your end of the deal, who gets priority? You can't have two people with equal priority. And usually if there's a bank involved, they are always going to want first lien, meaning they want to be the first ones to the table to collect whatever assets they can. So this means that when you have that conversation with a seller who's providing seller financing, let's just say they're not providing 100% seller financing. They're providing you $1 million of the $3 million in debt that's needed. So you have to get a bank involved. Well, that bank is probably not going to accept a second lien to that seller. So you're going to have a conversation with the seller up front and say, look, to get this deal done, if you're not providing me the full financing on this, I'm going to have to bring in a bank and you will have to take second lien, which means they will supersede you. And there's a possibility that you might not get anything if I default. Now, obviously, you don't want to tell them that way. That's not a great way to sell yourself, as Robert mentioned. So the way to approach it, though, would just be to simply state that the bank is going to want that first position and that they can come in second on that. That said, though, I've heard of banks having conversations with those sellers about giving that seller the first preference after the bank, because again, the bank is probably not going to want to come in and operate a campground. They're probably going to want to get it off their books as quick as they can. So if you can line it up appropriately, it'll give the seller the comfort to know that if you default, yes, the bank is going to step in to collect their debt, but that ultimately the seller can be in a position to recover the property.
I'm going to jump in on the seller carry just a little bit there too, is that obviously it's a little risky for the seller, but there's also been kind of some interesting stories we've heard along the way where the seller ends up taking back the property that the buyer defaulted. There was a significant down payment to the seller. So the seller got a good check into his pocket. Yes, he took over a property that wasn't ideal. It wasn't the same property that he had sold. But he trusted himself in the process to turn that property back around. And within a year, I believe, is when we kind of talked to him is all right, well, it's ready for market again. And so now he got a big check, gets the property back, has maybe a little fun, maybe a little stress of putting it back together. But he's done it before. So it was kind of a benefit to him. So the other part is when you're selling a property and you're looking at getting a big influx of cash, one of the big questions is, what do you do with the cash? I mean, that's always the big question I have in my mind. And well, I might have to 1031 exchange it into another property, or I might have to pay a ton of taxes. I might, how am I going to basically make money on my money? And the seller carry option is not just a way to reduce your capital gains taxes, but also the fact that you are putting an interest rate on it. So you're actually earning on the equity of the property that you have and that you're putting up. You're earning money on that money that's in the campground. So again, at passing it to your heirs, that legacy version of opportunity for your kids, whoever you choose. And, sometimes you don't need all that money. Like, do you really need that sitting in the bank account? My father-in-law might say, yes, he loves it. Some people might just be like, no, it's fine. I'm getting what I need every year and my living expenses are covered, et cetera. And just as another note to the SBA, we don't really promote that, but it has been a great option for many, many people. And there's a lot of brokers out there that offer it. I really suggest doing interviews with different banks. A lot of people carry it. So it's not just one option. The SBA, though, does take quite a while. And that is where we've been. That was the first hurdle, is like, whoa, this can take, 6 months to close the deal. It can take a long time for the SBA to be involved, and they have no guarantee. So if you are working in that regard, make sure that your seller knows that. I would be very upfront with them, because there is a high possibility of extension. So if you're buying that property, be on the lookout, be working with the sellers, making sure you're not getting locked into an unfortunate hard money on your earnest money. You want to make sure that you can run those extensions, because you really have no idea. And one of the benefits of the SBA is they don't care as much, in the sense that a bank is going to scrutinize everything. The SBA, a little more flexible. You're at the whim of the government. Not my ideal thing to just say, but the down payment is going to be a lot less, and the interest rate is typically less as well. So it's an avenue to step into the property for a little bit easier, lower money than you might expect from a bank.
Yeah, it's also good to have the conversations with those lenders on an ongoing basis. An example, the first time we did explore doing a USDA loan once upon a time, it was March, and they told us that they had already allocated their budget for loans that year, which was not going to reset until October. So effectively, there were no USDA loans given for 7 months. So if you had talked to a lender 3 months ago, you might want to check in again before you put pen to paper on that contract to make sure that option's still available, still exists. So, again, on the creative financing side, the main opportunity for you is going to be, potentially that seller financing. A couple things I want to mention. This is for my buyers specifically. A seller financing loan does not justify a higher purchase price. Maybe the seller is doing you a favor and giving you a loan that you otherwise might not be able to get. And, it might seem tempting to do so. They're typically going to want to treat it like they're doing you a favor. I would say quickly turn that script around and remind them how you're doing them a giant favor, putting that interest in your pocket their pocket that Justin mentioned, deferring those capital gains, all these things that are helping them. We've seen it time and time and time again when a seller will say, yeah, I'll give you seller financing. And then they try to raise the purchase price to do it. You're not helping yourself out if you accept that. Treat it like any other loan.
And it's risky too. When you get into a situation where they want a balloon payment, sometimes they'll say 1, 3, 5. Always go longer on your balloon payments if you can. 7 years, 10 years. You don't know how long you need to, and by balloon payment, I mean, like, when is that note due? So the sellers might say, well, you owe me the rest in 3 years. That puts you in a tight spot. What if the interest rates are in a bad situation in 3 years? We all saw what happened last year. When those interest rates climb, then it's going to be marketed on that interest rate, not the seller carry. So don't put yourself in a bad situation with the seller carry at a very reduced rate. We've seen it all, 3, 4, 5%. Now we're in the 7s and 8s. And if we had to jump out of a seller carry, there goes our cash flow. So we could be upside down real quick if we don't value the property, not the loan.
And just for anybody who's new in the commercial real estate space, let's talk about a couple terms that Justin mentioned there. So the balloon, we're typically used to in the housing world, you get a 30-year mortgage. It's called a fully amortizing loan because you make payments for 30 years until the balance is zero. You're going to have an amortization schedule on your commercial real estate loan. It's typically going to be 25 years, sometimes 20 years, but 25 is the most common we see, but you're never going to be fully amortizing. I've yet to see one that's actually fully amortizing. They're typically going to have a 5 to 7 year period, meaning that at the end of that period, 5 years, 7 years, whatever it ends up being, you're going to owe the full amount of the loan. Now, that doesn't mean you have to have the cash on hand that day. Typically, that means you do a refinance into a new loan with a new balloon. But this is something you need to be prepared for. And the reason Justin mentioned this is if you get a seller who says, yeah, I'll give you a year, 2 years. Well, depending on what you have to do to get that business that they left behind in a position to support the purchase price, it might take a year of effort and then a year or two to stabilize the books, because a bank is going to look 2 to 3 years backwards. So if you give yourself too short of a fuse, you might find yourself in a really bad position. If, let's say, you're buying the property for $2 million, but it's really only worth $1 million today based on the current performance, if you can't get an appraisal for the amount you need 2-3 years from now, whatever that term is, you may be defaulting or trying to sell early at that time to get out from under it. So did I miss anything on that?
Well, you don't have all the definition of what the balloon actually is either. In most cases, because it is tied to a future interest rate, it is tied towards future performance. And we've talked about many times the due diligence. You're really having to do an extra level of due diligence with the seller in that case because you're still, quote unquote, in business with them. And here's somebody that you've met, and are they going to be the type of person that 2 years from now they change the terms on you or they want to renegotiate because they know they've got a little bit of leverage over you with the balloon. So devil's in the details in that case of making sure that everything's defined. I'm also gathering from this is that like any time that I talk to a home buyer, go and talk to the lender before you go and get something under contract. You get something under contract, then Justin, you were talking about that you're under the deadline, you're under the gun, and you're dependent upon others. Talk about putting yourself into a stressful situation or potentially defaulting and getting yourself into some financial or legal issues. It pays to talk to the lender beforehand before you start dialing for dollars or start making your offer out to the campground. I know I've seen it in a couple Facebook groups. Hey, I've got this place under contract. Now what? Yeah, well, you should have thought of that before you put your pen to paper.
And that kind of brings up a reminder to me that this is the commercial space. Sometimes we have brokers that have come from residential space, maybe sellers that are more in tune with residential property. This is the commercial space. A lot of times we will get questions of, can I get a pre-approval letter? And I am yet to ever see one. I have fabricated one with a bank because I had someone that was so stuck on that idea that I couldn't work around it, and I really wanted the deal. But it essentially doesn't exist. So yes, talk to your lender, make sure you know what you're talking about, get the terminology down, have the financials ready for them. They're not going to provide that lender letter though for a contract, just so you know.
No, but you have a phone number, you have an email, you have somebody that you've talked to. Mm-hmm. If it's a regional lender, that gives you the comfort level of, are there USDA or state funds, grants, those types of things that are available to put the package together. So they, like you said, and at least they've done a once over on your own personal finances to know, is this even possible?
Yeah. Now, the last point for my sellers that I hear, my campground owners who might be selling and might be talking with a buyer who they are considering offering seller financing to. Remember, you can offer it up front because, as Justin mentioned, there are a number of benefits to you. One of them being, if that buyer defaults, you could potentially keep their down payment and then resell the property again, which, if you have the stomach for it, could be very lucrative for you. But for my sellers, don't forget to do your own due diligence. Don't just offer this seller financing somebody willy-nilly. Do the same things a bank would do. Ask for the documents, ask for the proof, the things that are going to make you feel comfortable giving this loan and getting into this potentially long-term relationship with this person who's buying your business from you. So, don't be afraid to ask for the things you need to do. Get with an attorney who's got experience writing notes to help you write a bulletproof promissory note on this. I always say that you should be drafting your own contracts anytime you can. So if you can do that, it would be worth your while as a seller to jump in and take that on so you can get the terms dialed in the way you want with your representation. Of course, we're going to have more discussions on this. There's so much nuance to this commercial financing. We're happy to share. We're going to answer your questions over on Patreon that you have about this and help get you steered in the right direction. If you're like us early on and you're stuck getting told no again and again by banks, to help you find that solution that might help seal the deal on your first property and open the door to outdoor hospitality. Thank you so much for listening today, gentlemen. Did we miss anything?
There's one or two more ideas I have, but we'll include those in the Patreon. You got to get on there.
That's in the Patreon. Yeah, we've got a couple other ideas, but sign up for Patreon.
Yep.
All right, we'll see you over there. This has been another episode of the Campground Catalyst Podcast. Thank you so much for listening.
See you.
Thank you for joining us on this episode of the Campground Catalyst Podcast, where we take you behind the scenes in the fun and gratifying world of outdoor hospitality. We hope you were inspired by today's show and better equipped to take the next steps in your journey. Remember, you can continue the conversation and connect with fellow enthusiasts by visiting our website and joining the Campground Catalyst community on Patreon at campgroundcatalyst.com. There, Patreon members get exclusive access to special listener perks, they get their opportunity to engage with the host, and they get their questions answered on one of our future upcoming shows. The Campground Catalyst Podcast is proudly sponsored by Beyonder Camp, your trusted partner in fueling your success in outdoor hospitality. Until next time, keep both your campfires and your passions burning.